Hi everyone, my name's Matt from Sønr and welcome to another in our series of discussions exploring some of the key trends and themes in the insurance space. Now today's session is less standalone and probably more part two to a discussion that I was lucky enough to take part in with Nigel and the Kanopi team later last year. And understandably, this focused on embedded insurance. And it went so well that we thought it'd be a great idea to nick all the best bits and to continue the discussion today. So this time around, what are we going to have a chat about? So together we're going to be exploring a question. So that question being, do incumbents truly need insurtechs to implement embedded insurance and participate in the ecosystem economy? So it's a big one. Now at this point, I'm at the risk of regressing to a schoolboy state of mind and excitedly raising my hand, desperate to chip in and give an answer to that. But no, instead, I'm joined today by an absolutely fantastic group who comprise of a variety of parts of that ecosystem, actually. So we've got leading commentators, we've got advisors, we've got founders and execs who are going to help us to explore various aspects of this question over the next 30 minutes or so. So, firstly, thank you everyone for your time. And without further ado, let's perhaps get started with some introductions. And Sabine, perhaps you could lead us out.
Hi everyone, I'm Sabine van der Linden. I run Alchemy Crew, which deliver R&D and commercialization labs between startups and corporates, to keep it simple.
Fantastic, thank you. Nigel, how about you?
Thanks. Yeah, my name is Nigel Fellows-Freeman. I'm the founder and CEO of Kanopi. We are a embedded insurance as a service platform, serving corporates and allowing them to deliver embedded products into third-party platforms.
Fantastic. Yuri, perhaps over to you.
Hello, everyone. I'm Yuri Poletto. I'm the founder and director of the Open and Embedded Insurance Observatory, and we run ongoing researches and intelligence on embedded insurance and open insurance, and provide advisory to the companies that want to do it in the best possible way.
Brilliant, thank you, Yuri. And last but by no means least, Mr. Kanon Hertz, over to you, my friend.
Thanks, Matt. Thanks, everybody else. Kanon Hertz, I don't think that I have the cool accent that the other panelists and moderator have, although I guess from an international perspective, my accent would be cool in and of itself. That notwithstanding, I founded a few companies. One of them is InsurTech Advisors, where I work with regional carriers here in the United States, helping them innovate and helping them partner with the appropriate InsurTechs to drive their agenda forward. And I co-founded a boat and yacht insurance company called Ahoy Insurance. So look forward to the conversation, and I'll turn it back to you, Matt.
Fantastic, thank you. Well, great lineup. This is really good. Thank you, everyone, for giving up your time. So enough of my preamble / ramble. Let's get into some questions. First one, we've got a bit of context, obviously, in the insurtech market, particularly, but also insurance, right? It's been a busy few years, a lot of challenges. So first question, so where can insurers look to create more value for shareholders? And how is technology going to play a role in delivering point solutions or revamping the value chain? Plenty of breadth in that one, so plenty of latitude for response. Maybe Sabine, from an opening perspective, you could kick us off, and then let's get everyone else's perspective too.
Sure. So, I mean, for me, when you look at insurance, we often look at insurance from, the growth the industry is creating. And I think between 2011 and 2021, that growth has been quite static. And so insurers have to start looking at the way they do innovation in different ways. And we have very interesting themes, as we know that entering the market on a continuous basis, partly because of the technological innovation driven mostly, I think, through artificial intelligence. So those companies need for sure to deliver value to shareholders, either by looking at point solutions, but also reinventing that value chain, every step of that value chain to make the engagement with the customer seamless. You know, we often talked about touchless, seamless, seamless or friction-free. That was the term I was looking for. And to be able to do that, insurance companies, and I think the market of insurance in general, brokers, reinsurers, need to really focus on that customer and that customer experience as a result, leveraging digital technologies. They have to look at data analytics, but I also would say ethics in the usage of those. We have seen so much happening with generative AI in recent weeks that I think it's very important to make sure that it's not, poor data in result in poor data out. So therefore, it's about balancing that human intelligence with that machine intelligence. But then at the end of the day, it's actually using digital enabled technology to ease that friction-free engagement and reducing risk at the same time. You know my theme, right? Dynamic underwriting. How do we actually combine all those bets together to deliver better customer experience?
Sabrina, I think that's
Matt,
so interesting. Oh, Keaton, go for it. I'm jumped in. You go for gold.
No,
all yours.
I jumped in too. Nigel, go ahead.
I just want to kind of pick up on the LLM thing. I thought it was really interesting, that period you brought up, which is that 2010 to 2021. Obviously, if you look on the macro, I think there's been a real macro, a very low interest rate environment as well. And so I think if you look at the kind of, the yields from kind of investment on the insurer side, they've probably struggled on that side, even though they've had some revenue growth on the premium. And so I think from terms of shareholders, I think there's some that could come together a little bit in terms of that interest environment, helping from a profitability standpoint, and that intersecting with a very large macro shift of kind of LLMs, etc. I think if you look historically, when really big companies have been created, they've generally been created in higher interest environments where there's been really big technology shifts, and those two things come together. So I actually think those two things is a real macro trend, is a real opportunity for really big companies to be created. The Googles, the Apples, those kind of really big companies have been created in those environments. And so I think that'd be something to watch in terms of play out of how they can really deliver shareholder value if there's some really big bets made in those two places.
So now my comments are really in two different ways. I was going to jump on the Chat GPT, which I'll do in a second, Sabine, because it speaks to technology and it speaks to the rapid evolution. And but before I get to that, Nigel, I want to just touch a little bit. You had talked about profitability and shareholders. So I think the issue of shareholders is dependent, right? So for a carrier, who are their shareholders? Is it a public entity? In which case, the decisions they have to make are decisions around, around quarterly returns, around returning value and equity value to its stockholders. But in a mutual or in a mutual or risk retention groups or organizations of the like, it's really the value is making sure surplus is maintained and that ultimately you are providing the services at the best possible price to enable the policyholders. And I think that nuance is going to become exacerbated in our current environment with technology. And that's where, so we're talking about ecosystems, we're talking about embedded. But if you just look at ChatGPT in a microcosm, what it is proven and what it is shown to be able to do, whether or not irrespective of, does it give you a little bit erroneous data, it still needs a human to filter it like after, but but it doesn't give that much erroneous data. And if you actually start to apply it to your own data, I've been playing around with it myself. I put in a data set from essentially from a software vendor that works in the old age home space. And I asked it, and I said, what are the important variables that I should look at to run my business? And out of 500 different elements that are collected by this system, it spit out probably the 8 that are actually, that any administrator would be watching, right? So that ability, that shortening of time is what is going to accelerate both the profitability challenges, the need to embed, the need to become more efficient. And unfortunately, there will be this tension between human bodies and artificial bodies. And I think, sorry for rambling a little bit longer, I think that the technology is evolving at a rate so much faster than we can consume it as a company, as a corporations, and a society.
Yeah, super interesting, Yuri. I think this for me feels like a really good point to ask for your input, given your role sitting in between various aspects of this ecosystem, right?
Yes, Matt. Thank you. I agree with all the other friends have said. I would just like also to focus a bit on profitability, because insurers, as every business, need to provide profits to the shareholders. So I have worked for 10 years in insurance companies, and I remind that when the insurers wanted to grow in the traditional economy, let's put this way, they got to their agents, brokers, and told them, get new business, do not mind about the loss ratio too much, mind about growth. And then after 3-4 years, it was the time of taking all the new business and remove the not profitable ones, so returning to profitability. So it was like a wave, grow profits. And I think that in this moment, we are in a moment where we are changing a bit between pure growth and profitable growth. So I think that insurance need to grow, and the best growth is the way to deliver value to shareholders. And if you just think at the protection gap, we see that the protection gap, not only in developing economies, but also in developed economies, the protection gap is still huge. So there is a huge potential to grow, a lot of space to grow. Just think to segments that are unserved, like creators economy, digital nomads. So we are talking about millions of people and micro enterprises that are completely unserved. Or think about micro and small enterprises. Their needs are completely unmet by insurers today. So there are plenty of opportunities for growth, but do not forget profits. To gain profitable growth, we see insurers today are leveraging on their internal assets and adding a layer of technology that can be built internally or sourced out externally. Technology and partnerships with brands that have customer bases. So, for example, think to the red click strategy of Generali. Think to Chubb Studio, Gallagher Mercer. So those are strategies and platforms through which those big insurers and brokers are building the technology that let them build a gateway between the insurance market and the end customers by partnering with the brands that have direct relations with those insurance customers. So this is my take on this topic.
Yeah, brilliant. Thank you, Yuri. I think sorry, Kanon, dive in.
This might be a transition into something else, but we're talking about profitability. We know that many of the insurtechs, whether they were enabling technologies, or trying to be digital MGAs or actual carriers, have really struggled with profitability. And I think this gets to Sabine's comment around 2000 to 2021 or 2010 to 2021, there was just this view, what Yuri said, which is just grow. The VCs and the investment community treated insurance and insurtechs like everything was software as service. when that failed, now it's a time of reckoning. But I think the issue then, which gets a little bit to your first question around, can insurtechs and incumbents, or can incumbents rely on insurtechs? It's the general question that any corporation, any established corporation has with its partners, which is, are those partners going to be around for the long time? And if those partners don't have a path to profitability, then it used to raise concern, but now it's raising concern even more, because the fuel that was pushing for that growth, which didn't care about path to profitability, is no longer there. So I think we are in this even bigger shift where, yes, I think carriers and incumbents need external relationships, but they need external relationships that aren't just one-offs and aren't going to disappear within 6 months to a year.
Yeah. We could easily spend an afternoon just discussing the state of the insurtech market, role of VCs and appetite. Certainly could go with everything you've said there. Well, I wonder whether that's actually a good segue into talking about the sort of models that we're seeing, and Yuri's alluded to a number of examples there, but what are your thoughts on about the insurance ecosystems? Do we see more insurers orchestrating their own ecosystems, or are they providing products as part of other already established ecosystems? What are the approaches that we're seeing? And Nigel, I guess from a kind of the front line, what are you seeing?
Yeah, I think it's I think that there's some examples where they've taken the orchestrate. There's a couple of insurers that have taken the orchestrator approach, and I think there's massive gains to be had from that. I think there's a bunch of research to come out from McKinsey and those kind of folks of like the percentage of the kind of revenue to be gained by the orchestrators versus the kind of parts of the system is kind of maybe 75-25. So a really big portion that the value sits there, but it's really hard to do. And it takes I guess a really long time, big investment. Obviously, you've got kind of folks like Ping An who have really kind of led the way in terms of showing how they can build these enormous ecosystems that they're the orchestrators of. But that takes a very, very committed group and a very committed shareholder group and very committed, et cetera, to make that happen. And so what we see a little bit more is wanting to nibble around at the sides, try and get involved, try and understand it, get kind of executive buy-in. Like, how can we prove some things up to say this is worth investment time, money? This is really something that's we're gonna have to change off our path of these 10-year digital transformations that we're already working on, but now we want to do this as well. So what we see day to day is that there may be some folks that really go big, and I think we'll win big off that. But a more general theme is how can they learn and understand and iterate into it versus kind of really go big and try and be the orchestrator, because that's a big leap to make. I don't know what everyone else thinks, but kind of that's what we see day to day.
Yeah, I will follow on to Nigel's point. So one thing I want to add is also to really understand the difference between the big players and the smaller players. I think the big players have the resources to become orchestrators. However, smaller players who want to be part of an ecosystem will actually hop and join an ecosystem to actually see how it works and actually leverage the assets and resources from the ecosystem. I think it's very important to think that and to understand that ecosystem operate in a very different manner from, if you don't mind me saying, profit and capitalist driven organization. Because in an ecosystem, you have to think less about yourself, but the members of the ecosystem across the value chain, where 1 + 1 = 10 is actually when you become a little bit more selfless. And the discomfort usually in ecosystem is when you have not built really strong trust amongst the members of that ecosystem. So I just want also to highlight orchestrator versus joining. It's also probably much linked to size. And then for it to work, you have to embed a lot of trust in the ecosystem. But the benefit of delivering ecosystem, if you actually understand truly your strengths and capabilities, you end up being able to build for the customer. You end up being able to build those frictionless engagement. You hop into people who are maybe stronger capability around data and analytics and artificial intelligence. You actually can generate new sources of revenue because you're working together to say, actually, maybe there's an opportunity here to tap into the protection gap and identify new product emerging risk, right? When we think about insurance, where together we can actually start building better for the world as a group rather than a single entity. And I think it drives probably better agility, flexibility, and adaptability, as working together means we are able to adapt much quicker, again, as long as we've built a trusted group of ecosystem players among one another.
And Matt, if I can, I think it's also worth spending a few words to talk about the main modern trends that are changing economic competition and paving the way towards ecosystems. So I would like to quote Alex Choninsky here. Alex is the head of embedded insurance at Gallagher Re. They are one of the members of the observatory. And talking about embedded insurance, but I think this also can apply perfectly to ecosystems. Alex says that the events that in modern history have given birth to embedded insurance are akin our parents' classic advice about finding a new job. They are all about networking, networking, and networking. So I think
very interesting.
It's not only the foundation of embedded insurance, but also of the ecosystem model as well. So if we look in the last decades, we have built technologies that are shifting our economies and business models in almost all the markets from closed loop, self-referential to open and networked. So particularly, there are three technologies that are driving this change, in my view. They are internet, mobile, and APIs. So internet has created the infrastructure to exchange data and to connect people and businesses. Mobile has made this connectivity available every time and from everywhere. And APIs are enabling every brand with a customer base to offer financial and insurance services to their customers. So this is the playing field also of ecosystems. And we know that the ecosystem model have grown, particularly in Asia, and now it's taking traction also in North America and Europe. Why in Asia? I believe that the main reason is why in Asia and in other regions that are not North America and Europe, there is less legacy than we have, less cultural and technology legacy. So if you wanted to introduce an innovation, it's more straightforward and quicker to introduce an innovation if you do not have legacy, technology and cultural legacy. And in Europe, in North America, we have a lot of tech and the cultural legacy. So people are used to go to an agent, to a broker to buy insurance, which will continue to be in the next centuries, I'm sure. But if you do not have this cultural and technology legacy, it's easier to introduce more modern infrastructure and modern solutions. So if you have a population and businesses that have been knowing about insurance in the last 10 years, they have known insurance digital. They have known digital insurance, not traditional one. So obviously, it's easier to introduce innovation in this kind of environment. So that's why, for me, the ecosystem model have grown and have become huge in Asia, particularly. But now we have realized the value, the potential of this model, and it's taking place and it's getting traction also in Europe and in North America, particularly. And we see not only in areas and the lines of business where we have simple products, but also, for example, in business insurance that traditionally have been considered too complex to be embedded or to be offered in an ecosystem. Today, this is not the case anymore. And probably, Nigel knows better than me. This has his company competing in this market.
So
Awesome.
I'm going to offer
Kenan.
I'm going to offer the contrarian opinion, or at least a little bit contrarian. And I think, it boils down to a little bit of what Yuri was saying, which is there's a regional variation and a regional difference, right? So what we've seen in Ping An, or what we see in India, are environments that are vastly different from Western culture, which gets to, I think, a little bit of what Yuri said. The cultural piece, I think, is much bigger than legacy technology. But that cultural part also bleeds into other areas of Asia. For instance, in Korea, everybody has an uncle who sells insurance, and if you don't buy your insurance from your uncle, then it's like a slap in the family's face, and it's a disgrace. So there are barriers that are non-technological that will have to be overcome. But moreover, at least here in the US, and probably including Canada, the integration is less likely to be led by an insurance carrier. They're more likely to want to participate, and than they are not. And I think you've seen it in a couple of interesting areas. CVS, right? Buying Caremark, CVS putting in health clinics in every, in not every, but in the majority of their pharmacies. You have Amazon and Amazon Health and Amazon Care, and Amazon now has partnerships where they're selling memberships in coordinated doctor's office parts, so that you can supercharge your traditional care here for not that much more money, and then they'll integrate the prescriptions, and everybody knows how it gets delivered, and it's easy delivery. So the healthcare providers will bolt into Amazon if it doesn't decide to do it itself. Although when they and IBM and I forget, it was McKinsey maybe, tried to design a health insurance product for their employees, it just didn't grab hold. So there will always be false starts, right? But ultimately we will progress. But at least here, I think the ecosystems will be driven by non-insurance companies, and it will therefore the ability for the carriers to inject themselves will both be a great opportunity, but those other ecosystems will also look at the fact that insurance is a cash cow and is profitable. And we see it on the auto side, right? Tesla is the simplest example. Ford is another example. Volvo cars here, and I think also in Europe, you can lease them and bundled in with insurance, and right. And so, who's providing that? There'll be this tension between let's partner with a traditional carrier, but maybe they can't be as nimble, or let's partner with a startup, but then they're not as stable, or let's just do it ourselves because we actually know more. And this gets to what Sabine and others were talking about earlier, which is just data, and if you are closer to the data, therefore you should be able to extract even greater insights than somebody one step further away from that original data source.
Ken, it's really interesting on that data set piece. So I think you're right. And I think I would extend it out to say that I think where the winners will emerge in that space is the ability to aggregate multiple data sources, not your single data set. And so I think historically, those folks have done a really good job of having a single data set and understanding that really well, and often historical. I think we'll see more and more like bigger winners emerge with the capability to bring multiple data sets together and have the capability to do that. The amount of carriers that I speak to that have 17 different systems, and the data sits in all parts of the company, and you can have an auto product and they don't know if the same customer. So I think those problems are still to solve, and I think the folks that do solve those multiple data sets, I think to extend your point, I think will continue to really grow.
What's interesting on that last thing about multiple data sets, and it's a little bit surprising to me, although I know that they do it a little bit, but not at scale. But the reinsurers and the reinsurance brokers essentially get access across hundreds, if not thousands, of carriers, and their depth of knowledge and of auto, right, transcends any individual portfolio. And if it would strike me that they are in an amazing position to rewrap that information and give it back in a blinded way, the same way IQVA does with healthcare data here, or Axiom or Experian do with sort of credit or financial data, or Plaid, right? Like, to me, there are actors in the insurance ecosystem who actually have so much more clarity or ability for clarity, but for whatever reason, there's sort of blinders. This is my little lane, and I stay in that lane, right?
Well, I would say, Keenan, if you actually talk to some of their insurers, and I think it's the continuous problem around data will be the data quality. Even though, they have access to a lot of data, it's also possible, I will keep it question mark, possible, that actually the quality of the data is not there. And so they still need to enrich their data with other data sources just to make sure that whatever they use in the scenario you've highlighted is correct. And I think what you will find is that even though access to data is there, it doesn't mean that the quality of data is there, though.
For sure.
Very good. Very good. Well, listen, I'm conscious of time. We probably got enough time to explore one more question between us, and we started to touch on kind of the capabilities, but also some of the limiting factors to enable these ecosystems to interact, or components of the ecosystem to interact effectively together. What about some of the? Let's maybe have a quick chat about the approaches that you're seeing. So, should insurers spend time balancing core operations and budding partnerships, or spend intensive time around R&D and on their individual digital transformation journeys? Do we have a sense of what's more effective, more appropriate in the short term versus long term? Thoughts and perspectives on any of that? Violent personal opinion or from the market, please.
Let me start with that, right? I think in the end, you have to, make sure your backyard is clean and weed free, or as weed free as possible, right? So you have to start with your own house and get it closer to order. That can be both looking outside to get support for where you either are missing capabilities or where the capabilities can be delivered. We've started this whole conversation around profitability, right? Where they can be delivered in a more efficient, effective, thorough manner, right? And so once you have sort of got a better sense of where you are, what your strengths, what your weaknesses, where you're wanting to go, where the world might be changing, right? At that point, you can now start to figure out, how much do I have to spend on innovation? Where do I outsource? Where do I insource? What are my key, to me, whatever is your key differentiator, your unique value, that's what you keep close to the chest. Anything else you can, outsource, so to speak. And outsource doesn't mean, the different company. It just means, figure out a different solution that might not be, that might leverage other approaches. And I guess that's how I would answer that question.
Very good.
What I would
Nigel, sorry, Steen, carry on.
I'm so sorry. I was going to respond to Keenan, because that was a very profound statement as well. But to remain competitive at the end of the day, I would say insurance companies need to be super proactive, right? And I call it probably ambidextrous. So you need to run the business, and, as Gartner would say, more company focus on running the business and transforming the business. And so still today, 70% of activities still is in running the business, doing the efficiency transformation, which, when you look at it in terms of value, from efficiency, it's still important. And I remember Dan Ingebiel talking on stage recently saying that when she looked at insurtechs, when she was at Lloyd's, she saw a lot of new systems, new solutions coming into the market, which were developing and delivering new capability, but not always taking cost out of the process. So I think for the basics, it's about efficiencies and making sure we can actually leverage that value back into the value chain and the ecosystem. But I think second would be, where the value is around game-changing and transformative initiatives, which mean looking at open innovation and looking at outside in. Otherwise, you just end up running, against your own tail and actually being quite insular in the way you are doing innovation. Actually, transformative innovation, high risk, but also high returns. So for me, ambidextrous, therefore, means you have to balance the two, the short-term lens into running that business, developing that top line, making profit, but also considering the fact that new technologies are coming in. We need all to be fluent into those new technology and know where we need to supervise so that we can actually make sure that we are aware of privacy laws and data breaches and all this stuff, which affect any legacy systems. But then, the three strategies would be, at the end, starting with strategy, right? Being clear around where you want to go. It will be around, we talk about balanced portfolio. So looking at it into a balanced portfolio viewpoint, maybe 60% in, efficiency stuff, 20% in much more new product and services stuff, partly with the sustainability themes coming into this embedded conversation we are having. And lastly, transformative. Being able to do balanced portfolio means that you're actually clear around where you are going. And then maybe together we can start looking at the right culture and the right talent, how you actually mix existing with new, and find ways to address the big problem we're all facing right now, talent gap.
Brilliant. Nigel. Sorry, I had a false start with you a moment ago, but your response or thoughts?
Yeah, I think it's interesting. I think there's a couple of ways that kind of, I suppose, which is, I suppose what we're seeing kind of in conversations we have in terms of how we're, these digital transformation paths, which are these kind of big hollowing out paths that the kind of general insurers are trying to take, which is like, how do they kind of consolidate some systems? How do they take some stuff out of their core and increase their ability to be able to partner? There's been a bunch of appetite to be able to partner, but often it's been a challenge to do that because of a bit of cultural as well as technological capability, I suppose, to do that. And so we're seeing that kind of run, I suppose. I think so, and that is going to be continuous, and I think that's going to increase the capability for partnership. I suppose if you think about those kind of boards, right? You kind of got that kind of build, partner, buy. What should you do at the moment? Build's really hard, long and slow. So how can we kind of hollow out to enable some partnership to be able to us to move quickly, like take some of these kind of big these big transformation trends that we can do, and then kind of how can we then maybe bring some of that stuff in house or accelerate through partnership. But I think maybe something maybe a little controversial, or like I think we'll maybe see through the year, is that buy piece, which we touched on it right at the top of the call, which is last couple of years, a bunch of venture, kind of bunch of young companies raised a bunch of money. Some of them, like the reality of growing companies is that some won't make it. And I think that kind of dearth of capital over the next 18 months, there'll be a bunch of runways that will run out. And I think the opportunity to buy some tech for some folks to leapfrog up that curve, I think is going to be there. So I suppose maybe a thing I think we may see over the next kind of 18 months or so is some really interesting purchases by a bunch of different folks. consolidation of maybe young companies together, and then consolidation of companies being acquired by some more incumbents. So I suppose that's that kind of build, partner, buy. There's maybe two kind of thought processes and how we kind of see kind of embracing innovation and then executing like on the coalface.
Fantastic. And Yuri, finally, any parting thoughts from you before we wrap?
Yes, so looking at my particular domain, that is embedded insurance and open insurance. So for insurers, reinsurers that want to find capabilities externally, there are plenty of opportunities, really plenty of opportunities. We publish every quarter a map of the embedded insurance enablers, embedded and open insurance enablers. So those are companies, typically tech companies, but not only, also data companies, for example, that sit in between insurance providers and distributors and enable embedded insurance or open insurance. And in the next map that we're going to publish in a few weeks, we have mapped over 130 companies. And I am sure that we are missing a lot, particularly in China and India. Probably they are at least 2 or 3 times this number. But they are a lot of companies, really a lot of companies. Many of them do more or less the same thing, more or less in the same markets, in the same verticals. So I also put in the shoes of insurers how difficult it is to find the right partner, the right company to partner with or to acquire. And then we also need to consider that insurers are very, very choosy when they want to partner with somebody else. They are not happy to open their data to third parties. They are not happy to expose their customers to third-party services. They have a trust issue to consider. There is a cybersecurity topic to consider. So they are very choosy. I perfectly understand the reasons. This is not necessarily the best approach, but I understand that there are the reasons. I think that in this moment we are at the stage of maturity of InsurTech where we are going from providing capabilities and technologies from a 360 perspective. So technology that can do a lot of things and that is addressing a lot of verticals. We are moving towards specialization. So I think that in the near future, we will see a number of insurtechs and enablers specializing in specific verticals, specific markets. And probably at that point, we will see also an increase in the number of mergers and acquisitions from insurers. So they are probably looking to opportunities that solve specific issues that they have, that help them to get to specific markets where they are not able to get through the traditional channels. So yeah, I think it's the landscape is evolving, and I think that we are going to see interesting things in the near future in this space.
Wonderful.
Matt, can I just jump in with one sort of last thought, and it gets to the remaining competitive component, right? To me, one of the areas that I think carriers or incumbents don't spend enough time thinking about, and it was heightened, let's say, this past week with the collapse here in the US and in Europe of Silicon Valley Bank and Signature Bank, right? That there are these black swan events that aren't typically modeled, right? And it's not that you can model a black swan event, but you can model what would happen in a event. And related to that, and I think this is where sort of you see insurtechs, let's say cyber, which there's been more activity with insurtechs than incumbents, is what is the future of insurable risk? You know, where will risk be in 5 to 10 years? Because if you're a carrier, yes, you have to do what Sabine said, is focus on the 80% of running your business today. But if that business materially changes, so everybody talks about climate, right? So if climate suddenly raises the sea level 1 foot in 10 years, right? Is your business different? Would you want to do something different? So what will risk look like in 10 years? I think that question, I know for a fact among boards and execs that I deal with, isn't discussed.
Yeah, but it should be, because it's all about emerging risk. And Kenan, what I believe is too much is being actually put around the 70% or 60%. And because the world we are living in changing so fast from technology viewpoint, from emerging risk, climate, social risk, we need to put a little bit more around that protection gap that you mentioned at the beginning of the conversation.
Beautiful. Well, it feels like a point at which we've come full circle, neatly joined the dots. I think that's all we got time for today. Just a massive thank you again, all of you, for your time and expertise, prep and viewpoints. That's been fantastic. I think it's probably set up for part 3 as well, but let's leave that for now. Thank you again, everybody, and have a great rest of the week. Speak soon.
Thanks, everybody.
Thanks.
Thank you.
Thank you.
Bye.